Good afternoon, everyone, and welcome to today's webinar, Foraging Through Forgiveness, Maximizing Your SBA Grant, Part 1. I'm Yonina Shineweather, CPA, the Consulting Director of Compliance at Viventium, and together we're going to be taking an up-close and personal look at the forgiveness process. Now, I have to tell you the truth before I even jump into the material, and that is that till the early hours of this morning, this was not meant to be part one. This webinar was meant to be the entire webinar. And as many of you have probably heard by now, late yesterday, Congress made good on its asserted goal of making forgiveness more flexible, or expanding it, if you will, making it more accessible, making it more relevant to most small businesses. And Congress passed H.R. 7010, which is expected to be signed by the president, perhaps even as we're speaking. The last time I checked, it wasn't yet signed, but will be probably signed in the course of today. And so that really opens up a whole new ballgame, because those of you who have begun to look at the forgiveness process, or perhaps you've even started filling out your forgiveness application, or you're working with your third-party providers, your payroll providers, to get the information you need, and you thought you had your mind wrapped around what needs to be done, well, a lot of this needs to be reevaluated. And so we're going to be doing a two-part webinar to cover, first and foremost, the breaking news and the changes, and what is changing, what isn't changing, what is likely to stay the same, and second of all, the entire detailed forgiveness application and process. Part one is today, and part two is going to be next Tuesday at the same time, 1 p.m. So for those of you who are just joining, again, I once again want to welcome you to today's webinar, and just a couple administrative announcements before I get started. First of all, today's webinar is being recorded. It will be available on the Viventium webinar site, the webinar section of our site. So those of you who want to hear it again, review something, share it with your staff or colleagues, it'll be there for you, and you'll be receiving some follow-up materials, including the slides as a handout after the webinar is over. So, be rest assured you don't need to write down all this information. You will be getting the slides. And the last point I want to make before beginning is that those of you who have done webinars with me in the past know I always say this. Please, if you have any questions as I'm going along, if there's anything that you feel is not explained fully enough, or you just want more information about, please do use your question toolbar. And I'm gratified to see that people are already using it, because those of you who have been in this know that I do keep my eye on the questions as we go along. I will attempt to leave some time at the end for question and answers as well. And if something is a question for you, it's probably a question for other listeners in our webinar today. And so you'll be doing everyone a favor by going ahead and asking the question. And so let's get started. An agenda of our two-part webinars. Well, we're going to be covering first and foremost today's breaking news, the changes to forgiveness, the expansion of forgiveness that is found in HR 7010, and how that's going to shake up some of the assumptions that we've been working under and change the way we're going to be looking at some things. We're then going to take a look at a dictionary of just common terms. There's so many terms in this forgiveness application, and it's so easy to get bogged down in the lines and lines of legalese and instructions. So just going to try to make some order in just understanding terms. And then we're going to take a look at this concept of covered period, as modified, of course, by the new law. And again, I just want to put the caveat that as of this morning, the bill was not yet signed into law. So when I call it a law, that's kind of used loosely, not in a legal sense, but it is expected to be signed shortly by the president. So we're going to be taking a look at what is this covered period? What choices do you have about picking a covered period? When would it be better to pick one as opposed to another? And then we're going to take a look at the actual flow of forgiveness based on the forms, the forgiveness form, Schedule A of the form, and the worksheet of Schedule A. And it's going to be kind of a colorful journey, almost a little bit like a basketball or a football strategy plan with arrows and lines. But I like to be, those of you who, again, have been in our Viventium webinars in the past, I try to be very hands-on. So we're not just talking, general words up in the clouds. We're talking, let's look at the form itself and let's work from it. And then probably in part 2 of our webinar next Tuesday, we're going to work our way through the form line by line. And finally, we'll discuss some factors that you need to keep in mind to maximize your forgiveness, meaning to maximize your grant. The forecast, what we're looking at coming down the road and around the corner as much as possible, and a little bit of information about Viventium itself. So let's get started with the breaking news. As I mentioned at the beginning, for those of you who are still joining, Congress did pass the legislation that we were expecting. The House had passed it a couple of days ago last week, and now, the Senate came through. They passed HR 7010. It's on its way to be signed. And there are 7, count them, 1 through 7 points that are changing in forgiveness. But before we even say that, just want to point out that any amount that for whatever reason does not get forgiven, hopefully it'll be 0 in your case, but any amount that for whatever reason was not forgiven by your lender or approved by SBA for forgiveness, you had heard before that it was going to be on the books for 2 years at 1%. Well, that term has now been extended to 5 years. However, it's 5 years for loans that are granted after the bill becomes law, meaning from today and on. What about everyone who's on the call right now, who most probably has gotten their loan before? So there's nothing to stop you and your lender from renegotiating the terms of the loan given the new law. That's the approach to take. In other words, it doesn't automatically get extended to 5 years, but we're hoping that lenders will be flexible in renegotiating loans with those borrowers who acted in good faith and took their loan before the flexibility. So that would be a question. If you do anticipate having any non-forgiven amounts for whatever reason, that would be a question for you to turn to your lender, to your bank or your authorized SBA lender, and discuss that with them. The main purpose of HR 70 is to increase the likelihood of forgiveness. So let's understand what the intent of Congress has been when it passed the CARES Act, and especially the PPP, the Paycheck Protection Program of the CARES Act. The goal was that businesses that are struggling during this critical time of coronavirus intense breakout will have the assistance they need to float them over the difficulty, so that even if their proceeds, their revenues are dropping, they'll still be able to pay 8 weeks of payroll because they'll get it as a loan. And if they use the loan for 8 weeks of payroll and they are able to get back up on their feet at least by June 30th, then everything will be fine and the loan will be forgiven and their businesses will continue to run relatively uninterruptedly. That was passed with the CARES Act when Congress kind of thought, perhaps overly optimistically or perhaps realistically, because it's very difficult to predict in these uncertain times, but they kind of thought that by June 30th, the economy by and large will be back on its feet, businesses will be open again, and everybody will be able to say, okay, let's put this behind us. And so therefore, they only gave us 8 weeks to spend these funds in a way that they could be forgiven. But now, with the reality, 8 weeks is not enough. And we all see that. And therefore, Congress has acted to extend that to 24 weeks. Basically, we had 2 months before, and now another 4 months are being pulled into forgiveness. 24 weeks or December 31st, whichever comes sooner. So that means if you take a loan and you don't get your loan till sometime in November for whatever reason, so if for those weeks until November, if that's when you first get your loan, so it doesn't matter, you're not going to have a full 24 weeks, you're still going to have that forgiveness ending as of December 31st. Okay, so that is the first, and I see we're experiencing a little bit of technical difficulties, so just bear with me while that should come up more strongly. Okay, I hope the signal is a little bit stronger now. So the first change of the bill is that you now get 24 weeks. Now, some of you may be shaking your heads from side to side and saying, 1 second here, we were all set to go for forgiveness now. We used our payroll, we restored our levels, we used up our entire loan, and we don't want to wait. Well, that's fine. If your loan was before the bill signing, which I'm imagining everyone's loan is, if everyone's on the phone now and has already taken a loan, then you can still opt to use the 8-week rules that we're going to be talking about soon. So it's optional. If you like the 8-week idea better, then go for it. Then take the application as it stands, fill it out, and submit it to your lender. They have to do their review, then SBA has to do its review. You do not need to wait. However, if your loan is after the bill signing, we don't know. That's one of the unknowns. We don't know if you can still opt into the 8 weeks, or if it's after the signing, then you must use the 24 weeks. We do not yet have guidance about that question. Another question, what if you're going to go with the 24 weeks and you're running along very nicely, and then sometime mid-July your business does manage to get back up on its feet and you're opening and your head counts are back up to what they were on February 15th or pre-February 15th, and your salary amounts, you've re-increased everybody's hourly rates or their salaries, everything is back to normal. Do you have to wait until the end of the 24 weeks to apply for forgiveness? Well, it's again a question that we do not have the answers to. And you might say, well, what's the rush? Like, if it's going to be forgiven, I can wait. Well, not exactly, because, and this was one of the questions that one of our first participants asked, sent over to me even before the webinar got started. IRS has spoken, and they have said that any amounts, any expenses that are being forgiven, let's say your payroll expense or your utility expense, if it's being forgiven, you can't claim it. You may not claim it as a corporate deduction. Now, as soon as I say the word corporate deduction, I say, okay, this is outside the purview of payroll. Viventium is a payroll and HR consulting solution company, and therefore I don't want to talk about corporate tax, but for those CPAs on the line, I'm just putting it out there that forgiveness decisions can take a long time, right? The bank has up to 60 days and SBA has time. You might not get a decision for, who knows, up to 10 months. So it's entirely conceivable that if you wait till the end of the 24 weeks to apply for forgiveness, you may actually have to file a corporate return before you know whether or not your payroll and other expenses are being forgiven. And there's some uncertainty there as to whether or not you want to actually take those expenses on your return, then perhaps have to file amended returns if they're forgiven, or will there be some adjustments where they'll let you, take them in 2020 on your 2020 corporate return, and then there'll be some type of a true up or an adjustment line on the 2021 corporate return. We don't know. And I'm just putting it out there that therefore some employers may actually be interested in applying for forgiveness earlier, before the end of the 24 weeks. And that's a question. We don't have an answer to that yet. This is too soon to know, but I'm just putting the questions out there. That's all point number 1 of the new law. Then there's point number 2. Remember how we said that when you apply for forgiveness, you can only take an annualized $100,000 for every employee, and that the 8-week equivalent of the annualized $100,000 is $15,385, meaning if you took that $100,000 and you divided it by 52 weeks and you multiplied that by 8 weeks, you would get $15,385, and so you can only count $15,385 of cash compensation. Well, we are assuming that if the covered period will be extended to 24 weeks, then the proportionate share of that $100,000 cap will also be extended. So if, expanded. So if we take 100,000, divide it by 52 and multiply by 24 instead of by 8, we get to 46,154. Now, of course, HR 710 doesn't say that, but we're assuming that that is the guidance that SBA will issue, so that's probably going to be correct. And again, that begs the question, well, remember with owners and partners, There were 2 caps, and if those of you who don't remember, we'll see it when we go through the form step by step. So for those of you that this sounds a little bit confusing or unknown, don't worry. I'm just assuming that I'm talking to people who've already been through it in detail with a fine-tooth comb. But if you haven't, don't worry, because I will be going through it with you with a fine-tooth comb between part 1 and part 2 of our webinar next Tuesday. But owners and partners who work for the company have to put up with 2 caps. They wear 2 caps because they're an owner and they're a partner, so they have to put up with 2 caps. Cap number 1 is like everybody else, the 8 weeks, $15,385. That's the max for cash compensation eligible for forgiveness. There's another cap, though, in the instructions, and that is they can't include more forgivable payroll than 50 seconds, in other words, 8 weeks out of the 52 of their 2019 compensation. So shall we assume that that fraction will be modified to read 24 50 seconds of 2019? Again, it's a question, and we are awaiting SBA guidance. When we take a look at our forecast of forgiveness toward the end of the webinar, we'll see, how likely it is that guidance will be coming around the corner soon. So that's point number 2. Not only was the covered period extended, but we can assume that the cash compensation cap will be similarly extended. Point number 3, SBA kind of surprised everybody. This was not in the CARES Act, but SBA surprised everybody in its guidance by stating that if you want forgiveness, the amount that you're asking for to be forgiven must be at least 75% payroll. And all those other stuff, the mortgage interest and the utilities and the rent, that can't be more than 25%. So that was what we knew before this bill. The bill came along and it made what's presumably a very welcome announcement. And it said, no, you only have to do 60% payroll. And you can use your proceeds, your loan proceeds for up to 40% of the other types of qualified expenses. That sounds like a flexibility. That sounds like an expansion that should make us be happy that we don't have to, have 75% of payroll, only 60% of payroll. However, beware. The way the law is written, and we do not know if this was intentional or not intentional, there is a 60 or nothing trap, a 60 or nothing deep pit. And what I've given you here on the slide, and again, the slides will be sent to you after the webinar, is the link to the law itself or to the bill itself. And I quoted it here in all its glorious legalese. And it states as follows: to receive loan forgiveness under this section, an employer, an eligible recipient, shall use at least 60% of the covered loan amount for payroll costs and may use up to 40% of such amount for interest on mortgage, utilities, and rent. Now note, it does not say may use at least 60% and may use up to 40. It says shall use 60% on payroll. Now that is scary language. And to show you why, again, I try to be as hands-on as possible. Let's use some numbers. Again, the bill states that you must spend at least 60% on payroll to be eligible for forgiveness. So the way things stood before the bill, let's say you got a loan of $500,000 and you had $100,000 in payroll and $50,000 in mortgage interest, rent, and utilities. So your total spent was $150,000. Could you get $150 forgiven out of the $500? No, because there is a 75% maximum, which we will see when we take our fine-tooth comb to the form. There is a maximum, and that maximum says the maximum is 75% of payroll. Okay, so I take my $100,000, that's the amount spent on payroll, divided by 75 to get, and I see, well, the maximum forgiveness is $133,333, because if I apply for forgiveness on $133,333, 75% of that is $100,000. In other words, I gross up the $100,000. The maximum I can get forgiven is $133,333. Okay, fine. So not my full $150 that I was hoping for, but at least a decent part of it. Along comes HR 7010 and says as follows: same exact scenario. You took a loan of $500,000. You spent $100 on payroll and $50,000 on non-payroll expenses so that your total spent is 150. What is your maximum forgiveness? Well, the way the language of the law is written, it's 0, because you spent $100,000 out of a $500,000 loan. That is 20%. You spent 20% on payroll, not 60%. And let's look back at the language. To receive loan forgiveness, an employer shall use at least 60% for payroll. It sounds like 60 or nothing. That's pretty scary. Now the question is, will SBA issue guidance to change that? Now, actually, Senator Marco Rubio made a request that the SBA issues guidance to expand that. Question also is, how much legislative room, how much room does the SBA have within the wording of the law? And of course, only the legal counsel at SBA can speak to that. Although that doesn't, the wording of the law doesn't seem to have limited SBA from doing some pretty surprising things in the past with the CARES Act. So we just have to kind of wait and see, because it seems that this was certainly not the intent of Congress. It doesn't seem that they intended to make it worse than it was before, but the law is the law until SBA comes along and clarifies how we're supposed to be approaching this. So that's a fourth point to keep in mind in our breaking news. And I think you're beginning to see why we've decided to divide this webinar into 2 parts, because just going through the breaking news itself is going to take up a good part of the time that we were going to be spending on the form itself. So let's look now at point number 5. There has been a safe harbor written into the SBA instructions, and that is that if you reduced your employees' pay in a way that would have caused your forgiveness to be reduced, or you reduced your employee headcount in a way that would have caused your forgiveness to be reduced. And we're going to see what that is specifically later. I'm purposely being a little vague, but if you did something that would have caused your forgiveness to be reduced, there was a safe harbor that as long as you restored those numbers to their pre-February 15th levels by June 30th, you are okay. If you brought your headcount back up, if you brought your employee salary or hourly rates back up to where they should be, then if that was done by June 30th, you're okay and your forgiveness will not be reduced. And as we said at the beginning, that kind of was a very optimistic, rosy glass, perspective of Congress that this is all going to pass by June 30th. And given the current state of affairs, the new law says you have now until December 31st to take advantage of this safe harbor. As long as you bring your headcount, as long as you bring your pay levels back up to their pre-February 15 amounts by December 31st of the year, you're okay. You're in the safe harbor and we won't reduce your forgiveness. So of course, the application is going to have to be revised to explain all of this, which probably SBA will be doing not so quickly, because they'll say, well, we have more time. I'm just, making a prediction here that they're probably going to take some time before they actually issue the new application. The new law, yesterday's law, also creates a brand new safe harbor that states as follows. Any reductions from February 15th and on till the end of the year, any reductions in FTE and headcount, we'll talk about specifically what FTE is when we take a closer look, but any reductions in headcount are not going to subject you to forgiveness reduction if any one of the 3 is true. You couldn't rehire the employees that you had laid off for whatever reason. You were unable to. Or number 2, you were unable to hire similarly qualified employees. So let's say you wanted to rehire employees and they said, no, we're under quarantine, or we're caring for family members who are quarantined, or kids who are out of school, or any reason that you're unable to rehire them at all. Or if you can't find similar employees to hire for those positions, or, and here's a very important one, if you are unable to return to your pre-215 level of business because some government requirement, whether it's Health and Human Services, whether it's the Department of Labor, whether it is the Center for Disease Control, and OSHA, and any government COVID-related requirement that was issued between brand new date, March 21st. I don't know where Congress got that one from, but another date to add to our cards full of dates here. But any government COVID-related requirements issued between March 21 and the end of the year that prevent you from returning to your pre-215 level of business. So for example, if you're a restaurant, hospitality, and you're still not allowed to open up for, then you meet this. Or even if you can open up, but due to other government restrictions, you can't return to your full functioning because of any government regulation issued from March 21 and on. So for all those reasons, if you can't bring your FTE up, and by the way, you have to be able to document these reasons, of course. If you can't bring your FTE up back to its pre-215 level, you will not have to be subjected to forgiveness reduction. So here's another reason that we're going to be looking at a new kind of application, which is going to have to include this new safe harbor as well. And a pleasant surprise, the last piece of news in our breaking news of forgiveness is that employer Social Security deferrals, remember those? They were allowed by the CARES Act, that you could defer your portion, not the employee portion, but your portion of Social Security for your entire payroll. Doesn't matter, people working, not working, COVID affected employees or not, but your entire employer Social Security liability was allowed to be deferred 50% till the end of 2021 and another 50% till the end of 2022. But that was only allowable up until the date of your PPP forgiveness decision. So at the point that your lender told you your PPP loan is forgiven, you had to stop deferring. Well, Congress has acted in HR 7010 and said, no, that's gone. You can keep on taking employee Social Security deferrals, even with a PPP forgiven loan. But they stopped short of saying that you could also use the employer retention credit. That they did not change. So the two still don't mix. The employer retention credit and the PPP loan do not go together. But employer Social Security deferrals are allowed to continue even after your loan forgiveness. So if there are any of you who perhaps are on the verge of receiving a forgiveness decision and you were already planning to stop your deferrals, you may continue them even when your loan is forgiven under HR 7010. So that is, in a nutshell, the breaking news. I want to address one or two of the questions that have been asked, although we'll try to leave some time for Q&A at the end. But one question is, and this is a very good question that I think we're all asking, can we still use the original safe harbor, meaning June 30 instead of December 31, even if we use the 24-week measurement period? In other words, can we mix the best of both worlds? Let's say we bring our levels back up by 6:30. They might dip again, but can we kind of cut it off there and still use the 24 measurement period? So it's too early to have a definitive answer to that question. What we can pretty much say with safety is that if you're opting to use the 8-week period, then you could probably just go ahead and file the application as it is based on June 30 numbers and 8 weeks. But if you want to also, if you also want to benefit from the 24 weeks, then I would venture to say they're probably not going to let you use the June 30. But again, that's just a guess and a speculation, because it really is too early. This just happened yesterday and there is no guidance. Thank you for asking that question. Another question's asked here. The 40% other expenses, that would be the mortgage interest and the rent and the utilities, are they also subject to the December 31 extension? And the answer is yes. All qualified costs are now given that extension to be used. In other words, your covered period is extended for I don't want to say December 31st, I should say for 24 weeks. It's 24 weeks or December 31st. When my sound was going down before, I clarified that it's December 31st if it comes sooner. So if you took a loan sometime in November, you don't have 24 weeks. You only have till December 31st. But for most of us who have the loans out there already, and and you're able to you've taken the loans or you're taking them soon, you'll have the full 24 weeks before the end of the year. And yes, the other types of expenses are also extended for those 24 weeks. Okay. Now, let's open up our dictionary, and it's nicely alphabetized here on little index cards, and it might help you to have side by side a copy of the forgiveness application, because these terms are taken from the forgiveness application. And even though we have all this breaking news and new developments, these terms are going to stay. So I think it's important that we understand them. I want to start with the only one that's not in alphabetical order, which is the last one, and that is certifications. There's been a lot of talk about certifications. Well, if you look at your application, your forgiveness application, page 4 is an entire page devoted to certifications. And those are representations that you, the employer, are making that your information is accurate, that you had economic need for the loan, et cetera, et cetera. Now, the talk was that loans under $2 million will not be scrutinized for certification accuracy, meaning it will be assumed by SBA that loans under 2 million, the certifications on them were made in good faith. That does not mean, as people originally jumped up and said, that loans under $2 million will not be audited. That is not correct. All that SBA had said was loans under 2 million, they will assume that certifications were made in good faith without scrutiny. So that's as far as certifications go. But they reiterated that they may review any and all loans and audit them. And if indeed a loan was found to be not due to economic need, there can be serious consequences depending on the level of misrepresentation, et cetera, that was involved. Certainly the forgiveness may not be granted, and perhaps the entire loan will be required to be returned, et cetera. So you want to just make sure that your certifications are accurate. Now, an EIDL advance, let's go back to the top of our dictionary. That's on your page 1 of your forgiveness loan, the main form. Stands for, if you don't know what it stands for, then you probably don't have to worry about it because you probably haven't taken one. But early on in the coronavirus crisis, SBA issued, before PPP, an economic injury disaster loan program, another type of SBA loan, and they issued advances on that loan, and so that is taken into account in figuring the amount of your PPP loans. So they're asking you for the EIDL advance amount. It was up to $10,000. We do a lot of talking about forgiveness. Forgiveness does not have to be 100%. There is such thing as partial forgiveness. And there's lots of reasons, which we'll see when we start going through the form in part 2 of our webinar, lots of reasons that you may not, or someone may not get full forgiveness. Perhaps they've reduced pay more than they should have and haven't restored it. They've reduced their employee headcount. They spent more than the acceptable percentage on payroll, lots of reasons. So forgiveness may be partial. And just to remind you that any unforgiven or non-forgiven amount will stay on the books at a 1% rate of interest. For it was 2, and now it's been expanded, as we said at the beginning, to 5 years. But those 5 years only apply to loans after the date that HR 7010 is signed, which is probably today. Those of you who, probably most of you, have the loans from before should reach out to your lender for renegotiating terms of your loan if you anticipate having any non-forgiven amounts. Now, FTE gets bandied around a lot. FTE was really a concept created basically by the ACA, although SBA has used FTE in the past in a different context. When we talk about FTEs for ACA, we mean 30 hours a week is called a full-timer, and anybody less than 30 hours a week is called a part-timer, and we just add up his hours. So 2 employees working 15 hours each equal 1 FTE for ACA purposes, so the Affordable Care Act. SBA's definition of FTEs has traditionally been 32.5 hours a week. But in the context of PPP, forget ACA and forget SBA's previous definition, the number to remember is 40. Full-time equivalent units for PPP are measured at 40 hours a week. That means anybody who works 40 hours or more is a full-time person. That's 1.0 FTEs. And anybody who works less than 40 is something less than 1.0. How much less than 1.0? Well, look at your 2 next definitions. There are 2 ways on your PPP application to figure your FTEs for those who work less than 40. You can use the FTE exact calculation, And you can use the FTE simplified calculation. Now, those of you who are with Viventium, well, you'll be seeing on our forgiveness tool that we're producing for you, you'll be seeing both calculations. So you'll be able to see which one is more beneficial to you. Those of you who may be partnering with other payroll services or payroll providers, you want to reach out to your partners, or if you're using off-the-shelf software or your in-house software, you want to make sure that you're being given the option of either the exact or the simplified, whichever is to your benefit. What's the difference, and when is one to your benefit more than another? Well, the exact calculation says you take the weekly hours worked by an employee, divide it by 40. Okay? If it is more than 40, just leave it at 1. If it is less than 40, use the appropriate fraction. So let's say someone worked 20 hours that week. So it's going to be 0.5 FTEs. And if someone worked 10 hours, it's going to be 0.25 FTEs. That's called the exact calculation. The simplified calculation is just that. It's simplified. If someone works 40 and more hours, they're a 1.0. If someone works less than 40, they're a 0.5. Doesn't matter if they work 10 or 20 or 5, they're just going to be a 0.5. Now, when is it to your advantage to use the simplified or the exact? How do you figure it out? Well, like this. If the majority of your employees during your 8-week period are working less than 20 hours a week, then you probably want to maximize your forgiveness by using the simplified calculation. Because if they're working, let's say 10 hours a week due to COVID, and you've really had to cut back during your 8-week period, or presumably your 24-week period, and they're working 10 hours a week, let's say, you're going to have to show them, if you use the exact method, is only a 0.25 FTE. And remember, the goal is to make sure that your FTEs during your covered period is just as high as your pre-February 15, well, as your look-back period level. So how do we get the number higher if you have people working less than 20 hours a week? Use the simplified calculation, because then they're all going to count as 0.5s, not 0.25s. My goal is to maximize the numbers that I have as much as possible during those 8 weeks. Now, of course, it will also depend on what it looked like during your look-back period. But if we assume that you're operating at lower levels during your 8-week than you were during your look-back, it would be to your advantage to use your simplified calculation for employees that are working a lot less than half-time. Now, I referenced a moment ago about comparing two numbers. We have to, in order to make sure that you get full forgiveness, you have to compare, and the forgiveness application makes you compare, the FTEs during your 8 weeks / 24 weeks compared to a look-back period. That's called the FTE look-back period. That's your next definition there. And the FTE look-back period is a baseline for checking out if you've had headcount reductions that will reduce your forgiveness. Meaning, if during your 8 weeks, your FTEs were less than your FTEs during your look-back period, then you're looking at forgiveness reduction by the same percentage. You had only 90% FTEs compared to your look-back, well, you're going to have a 10% forgiveness reduction. Again, in other words, if your FTEs went down by 10%, your FTEs went down by 25%, you're going to have a 25% reduction of your load. Now, of course, everyone's hand's going to go up now. If you start thinking about that, you'll say, well, that's not fair. The look-back period is so long. It could be 12 weeks, a long time. How can I compare 12 weeks to 8 weeks? That's so not fair. Everyone's going to go down. So they're not comparing absolute numbers. They make you do an elaborate calculation on the form, which again, I have to reassure all of you who are listening, who are with Viventium, we do that elaborate calculation for you. You're not going to have to start in with Excel spreadsheets or calculators or anything like that. But there's an elaborate calculation that equalizes. It takes the FTE during a look-back period, it equalizes it to an average, and you're comparing averages, equalized averages, not literal numbers for those weeks. And you get to pick what your look-back period is. You can run it from February 15th to June 30th of last year. You can run it from for the first 2 months of 2020, or if you're a seasonal employer, they let you pick any consecutive 12 weeks between May 1 and September 15 of 2019. again, I don't want to sound like a broken record, but those of you who are with Viventium, we will show you all three options on our tool, and you can pick. You'll be able to be using the numbers that are best for you, and that's fine. That's legal. That's perfectly acceptable according to SBA. And again, those of you who are not with Viventium do want to be reaching out to your partners and making sure that they're giving you an option so that you can decide, or at least they'll show you, how the calculation is being done, of which of these three periods works better for you. Again, your goal is to have the lowest possible number during the look back period. So you want to see, where is your look back period lowest? February 15 to June 30, January 1 to February 29 this year, or for seasonal, those 12 weeks. You want to get it down as low as possible so that the baseline that you have to live up to is as low as possible. And then we come up to the bad thing. The bad thing is an FTE reduction. That's when there's been a decrease in the equalized amount. It's not absolute numbers. It's an equalized amount, as I just said. It's a decrease in the equalized amount of your FTEs during your 8-week or 24-week period relative to the FTE look-back period. Now, Congress did not change the look-back periods. The HR 7010 does not change the look-back periods. Will SBA change them for any reason? I don't think so. Again, it's just my guess. There's no reason for them to change them because, again, we're dealing with equalized numbers. So if we're equalizing, getting averages, it doesn't really matter if I'm equalizing 8 weeks or if I'm equalizing 24 weeks to compare to the look-back. So I would assume that SBA will leave these periods the same for the same reason that they picked them now. Again, that's just a guess. Well, we're going to see what's going to be happening. What's an FTE reduction exemption? Kind of like a double negative. Well, a reduction is a bad thing. A reduction means my FTE count went down, and so I have to take whatever percentage it went down by and multiply that by my forgiveness amount. I have to reduce it. That's bad. That's bad. So a double negative would flip it the other way, and yeah, it does. An FTE reduction exemption is good. It means for some reason my company is exempt from reduction if my FTEs go down. Again, as the definition states here, the number of FTE reductions that will not reduce forgiveness due to extenuating circumstances. Some of those circumstances, we'll talk about them when we go through the form, but just to give you a sneak preview, if you're not familiar with them, would be you tried to hire back employees and you made them a written offer of a job at the same conditions that they had before, and they refused the offer, and you notified your state unemployment office. That's a lot of ands. Written offer, same conditions, employee refused, you notified state unemployment office. All 4 conditions must be there, but if they are, then the hours that went down because that employee left, the FTEs that went down, do not reduce your forgiveness. Another extenuating circumstance, the employee was fired for cause. Plain and simple, documented, of course. Employee fired for cause, the FTEs that go down because that employee was fired for cause and you couldn't rehire a similar employee for whatever reason, they're not going to reduce your exemption. They're not going to reduce your forgiveness. Okay, probably under the new law, remember that new safe harbor that you didn't return to your level or you were unable to rehire, or probably those will also be reduction exemptions. That's my guess of how SBA will implement what Congress has mandated. We're probably going to see more extenuating circumstances. So that's a reduction exemption, which is a good thing, and you get it by falling into one of those extenuating situations. Like you would like to rehire, you'd like to raise your FTEs, and for whatever reason, you can't. What's the FTE reduction quotient? Well, the quotient is one number divided by another number, a ratio, right? That's a ratio of the FTEs during your covered period, 8 weeks, 24 weeks, whatever it'll be, to the FTEs during your FTE look-back period. So if I had 100 FTEs during my look-back period, and I only had 80 FTEs during my 8 weeks, 80 divided by 100, that means for 80% I'm good, and for 20% I'm not good, and 20% of my forgiveness is going to be reduced. Your loan disbursement date, enough about FTEs, that's the date that you receive the first installment of your loan. People ask me, well, I've gotten a few installments of loan. The answer is you go by your first installment, your loan disbursement date. And the reason that date's going to be significant is because that's going to be the beginning of your 8 weeks and presumably the beginning of your 24 weeks as well. The payroll cost 75% requirement. So we worked through this above. We said that you can't ask for forgiveness for an amount that's more than, that's comprised of more than 75% payroll, which has now, of course, been changed to 60% payroll, but we're still waiting guidance to see, how that's going to actually look. So again, we said that you have to make sure that you're, and by the way, even if you have other costs, utility, rent, mortgage, you don't have to claim them. You can put your whole forgiveness into payroll, and whatever you do claim is not going to be a corporate deduction. So you may have various reasons for not wanting to claim utilities, rent, interest on mortgage. So that's fine. You don't have to. You can put everything into payroll if you want to, but it just can't, the amount of payroll can't be less than 75% or 60% under the new law. The form asks for your payroll schedule. Now, this is a matter of some confusion here. It means your standard payroll frequency. Now, what if you have multiple payrolls with multiple frequencies? You pay perhaps your executive administrative on one frequency and your manual workers on a more frequent frequency. This has actually been one of the questions that Viventium has submitted to SBA via the American Payroll Association for clarification. We're awaiting guidance, but, and this is a refrain I know I've been saying a lot also, ask your lender, turn to your bank, because they're the ones who are going to be doing the initial review and issuing an initial forgiveness decision. So any of these types of questions should be directed to your lender. What we're afraid of, but what we will probably see, is varying answers. Just as happened when employers were going for their loans, various lenders, various banks had their own interpretations and their own set of requirements that they were implementing and making loan decisions based on. We're probably going to be seeing a similar type of uncertainty around the forgiveness, and probably lenders will be implementing requirements as they understand them. And so what you want to be doing is directing all of these types of questions to your lenders. Okay, we're up to the last entry on our dictionary, and that is the salary or hourly wage look-back period. That's a mouthful. That's very similar to the FTE look-back period, similar in concept. Just like you have to maintain your FTEs in order to get full forgiveness, you also have to maintain pay levels, salaries for salaried workers or rates for hourly workers. And you have to maintain them relative to a look-back period. And you don't have a choice of this one. With FTEs, they gave you 2 or 3 choices. With your pay look-back period, they only give you 1 choice, and that's from January 1 to March 31 of 2020. That's the baseline for pay reductions that will reduce dollar for dollar your forgiveness. In other words, FTEs reduced by percentage, pay reductions reduce your forgiveness dollar for dollar, unless you meet certain safe harbors. But basically, that is the concept of the look-back period. You take your 8 weeks, your 24 weeks, you compare it to the first quarter of 2020, and of course, all of this is equalized. We're not looking at absolute pay, we're not looking at absolute numbers. We're doing an annual average equalized calculation. Once again, this is something that the Viventium system takes care of for our clients. Once again, this is something that you want to reach out to your providers and make sure that they're doing that calculation properly. Okay, let us talk about the periods of forgiveness. And right now I'm going to be talking about the 8-week option because that's the one that we have a clear understanding of. Presumably the same type of idea will be extended to the 24-week option, but under the 8-week option, which again is still available for those of you who want to opt for it if you've gotten your loans before the new law, there's really 2 choices. You can use what's called the covered period, or if you have a weekly or a biweekly frequency, not less frequently than biweekly, you can use what's called the alternative payroll covered period. And there's advantages and disadvantages depending on your own payroll, and you can pick either one depending on which way it works for you. At Viventium, we're going to be allowing you to run a report selecting either covered period and seeing what your bottom line of forgiveness is, or alternative payroll cover period, the APCP, and seeing there what your forgiveness is, and you can opt to file either one with the SBA. Under the covered period, you start from your loan disbursement date. So we've taken an example here where your loan disbursement date, that again means your first installment, falls on April 13th. Monday, April 13th is when you actually got your first disbursement. And that's the beginning of your covered period. And it ends 56 days later, 8 weeks later, on June 7th. Began on a Monday, ends on a Sunday. You can count them. There's 56 days there or 8 weeks there. And any check date, any payroll check date that falls within that covered period, because the amounts are paid, those expenses are going to be included as eligible expenses for forgiveness. Okay. Same thing for amounts paid or incurred, rent, utility, mortgage, can be incurred or paid during that period. Now, what if you incurred payroll but you didn't pay it yet by the end of by June 7th, because your pay date is a couple later, your standard pay date? That's fine. It's still going to be available as long as you don't extend your pay date beyond your regularly scheduled payroll date. As long as you're not like trying to play any tricks, any shenanigans, you're just following the regular payroll cycle. That's fine. Even if as long as it's been incurred during your cover period. What about your alternative payroll cover period? So this was meant to make it easier for businesses that instead of having to have a covered period and then looking, well, check dates in that date, out of that date, they said, no, let's just bring the covered period, the 8-week period, in sync with payroll. You got your loan on April 13th, fine. When does your payroll start? What's the beginning of your payroll cycle? It's Wednesdays. Fine, forget about the first 2 days. Forget about the 13th and the 14th of April. You can call your 8 weeks starting on the day that your payroll period starts. It's the first payroll period start after your loan disbursement date, which in my example here is April 15th. And then the payroll period runs all the way till June 9th. And that's exactly in sync with your payrolls themselves. So you don't have to start like fitting your payrolls into an outside independent measure of covered periods. It was done for administrative ease of employers. However, it leaves the door open for analysis. So by way of example, if you had a large payroll that was, let's say, paid on a check date of April 14th, under the covered period, you'd be able to claim that because the check date is within the covered period, and you would be able to use those amounts toward payroll forgiveness, toward PPP forgiveness. However, under the second method, you would not be able to use a payroll check date, a payroll that was dated and before the alternative payroll cover period began, because April 14th is excluded. We're only looking at payrolls that fall within the standard payroll cycle that began on April 15th. So you need to know yourselves what your payrolls were like. If you had large amounts, there's a little bit of a leeway there that you may be able to benefit from the covered period end. And presumably if you had larger amounts on the other end, it could work the other way, but it's much more likely that your payroll was higher in April, before we really went into the thick of things, or at least I'm just picking April as an example. Of course, everybody's dates will vary, as opposed to having a higher payroll on the other end. So again, it's a matter of analysis. You'll want to check with your software, your payroll providers, and just ask, how can you help me do this type of what if analysis? What if I use covered? What if I use my APCP? Which way comes out better for me? And now we're going to get into the sports strategy plan over here with our arrows and our circles, and we're going to start to go through in a very colorful way the loan itself. Now, since we only have about 5 minutes left to our webinar, we will be continuing part 2 on Tuesday, this coming Tuesday at 1 p.m. I'm just going to do the very first few fields of this application for you, just to give you a little bit of taste of what we're going to be talking about next time. I also will assume that there will be additional guidance by next Tuesday, not all of it, but there probably will be some. And so we may need to actually backtrack to some of our earlier discussion and modify that as well. But for now, I just want to get a bit started with the flow of forgiveness. So this is, for those of you who haven't seen it yet, brand new, and for those of you who have seen it, may be familiar already with it, the PPP loan application. The PPP loan forgiveness application. It has 3 basic pages. Page 1 is the calculation form. That's the main form. Page 2 is the supporting schedule. It's not page 2, it's further on because there's lots of them. It's an 11-page packet, but I'm just saying the forms itself. There's Schedule A, which supports the calculation form. And then there's the Schedule A worksheet, which supports the Schedule A. So this is how it's going to flow. At the top, you put your loan numbers. Your loan number for SBA may be different than the number that your bank assigned to you. The loan amount, which is the maximum amount that you can get forgiveness for. Apparently, not for the interest on the loan, apparently. And that date that we mentioned before, your loan disbursement date. And that's going to be the beginning of your covered period. And then they ask you 2 interesting questions. Employees at time of loan application and employees at time of forgiveness application. I have no idea why. Nobody has any idea why. This has nothing to do with FTEs. They're not asking for FTEs. They're just saying employees. Presumably they mean employees who are getting paid, active employees. Is it for statistical purposes? Are they doing some type of a survey? I don't know. These numbers are not used anywhere in the calculation. Kind of like Social Security tips. Some of you may always, be scratching your head when you fill out a 941. Why are they in your W-2? Why are Social Security tips broken out from Social Security wages? That's one of the unanswered mysteries of payroll. It's just there. And then they ask you for your economic injury advance amounts, as we mentioned before, and the application number, because that will also be factored into your forgiveness, and your payroll schedule, which probably means your largest portion of your payroll schedule. We don't know. We're awaiting guidance if you have more than one frequency, what to put there. Your covered period, as we just discussed, will begin from your loan disbursement date plus 55 days, meaning a period of 56 days. Your alternative payroll, if applicable, that means only if you're weekly and biweekly, will start from your first payroll start date after your loan disbursement date till 8 weeks after that. And here's the checkbox for $2 million. Doesn't mean you won't be audited. Again, I keep stressing that. It just means that your certifications will assume to be made in good faith. Then we come to the numbers. Payroll costs that are eligible for forgiveness. That comes from here. It comes from Schedule A, line 10. Now, what is Schedule A, line 10? It also says payroll costs. Schedule A, line 10 is line 1, plus line 4, plus line 6, plus 7, plus 8. And there are the lines over there, and 9. Basically, it's the cash compensation paid, that's line 1, to eligible employees. And the second kind of cash compensation paid, because we break employees into 2 categories, as we'll see in the future, but all the cash compensation. And then it's amounts paid by the employer over here on line 6 for employer health insurance, amounts paid by the employer for employee retirement plan contributions, and any employer taxes on employee wages, such as state unemployment insurance tax, SUTA. And then you have broken out separately the amounts paid to owner employees, partners. We don't really have a definition yet of an owner employee. There's been no definition issued yet, but the amount is there. And the reason that owner employees are broken out separately is because they wear 2 caps, so they're subject to 2 caps. They have an extra cap to their compensation. All those amounts get added up, and then they flow forward onto payroll costs. Now, I'm going to skip for now over the remainder of the forms in the interest of time, and I just want to take a little look. I'm going to skip over these factors too. Don't worry, we will get back to them in part 2. I want to take a look though at the forecast of what's coming up. There are rumors out there that SBA has a 30-question FAQ prepared and ready to go, which they were not ready to issue yet until Congress acted. They were kind of keeping their eye on Capitol Hill. Congress has acted yesterday. The president will most likely act today, if not already. And we are encouraging SBA, please let go of those 30-point facts and issue them to us. Modify them, of course, for HR 7010, but please do issue them so that we can, have as much guidance as possible. There is also a strong lobby effort mostly on the part of large banks and financial institutions that all loans under 150,000 should be forgiven because just the administrative work is just not worth the effort. We don't know where that's going to go, but there is a strong lobby happening about that. What we can say with surety is maintain as much documentation as possible. Keep your records, any employees that are laid off, why they were laid off, any employees that you're offering to bring back, under what conditions are you making the offer? Have they accepted the offer? Have they acknowledged the offer? Have you reported it to the unemployment office? All your payroll records, keep them, maintain everything. There are still over $100 billion in PPP funds that are available that have not yet been taken advantage of. So those of you who have not yet received a loan or applied for a loan, this is certainly a very apropos time to do so. And again, as a best practice, you want to be turning to compliance thought leaders in the industry for updates following Viventium, following our updates. Promote agility within your organization. Changes may happen quickly, and an organization needs to be able to pivot around them and learn as quickly as possible, and have advisors, your tax advisors, your legal advisors, other thought leaders in the industry that can advise you and give you tips of how to maximize forgiveness. Viventium will be sharing with you, once it's been updated for the latest law change, a couple of very nice resources. One is a division of responsibilities. And it says here Viventium report, but that would apply to any payroll service that you're using. These are the fields that basically you would be expecting to get from your payroll software or your application that you're using, and the ones that say client would be data that you'd be responsible for. And of course, this is just in the Viventium color scheme, the journey to forgiveness and the milestones along that journey. So these are resources that will be updated for the latest in the law and will be shared with you after the webinar. And unfortunately, I know I was able to get to only very few of your questions and refer to them as we went along. But in part 2 of our webinar, we will try to, in addition to covering the rest of the form in detail with arrows, with directional maps, and really combing through the form with a fine-tooth comb. But we will also try to allow some time for the very important part of Q&A, because I know there are a lot of questions out there. Unfortunately, today the answer to most of those Q&A questions are just wait and see. And hopefully by next Tuesday at 1 p.m. when we regroup, I'll be able to provide you with some additional answers. For now, I want to thank you very much for your time in joining. Again, the webinar has been recorded and it will be available at viventium.com on our webinar section of our website. Thank you very much, and looking forward to speaking again on Tuesday.